2 in the morning.
That's my favorite song.
Aloha, everybody. Thanks for being here. We'll wait for more people to hop on live. But just to give you a debrief, all of the partners, except for me, went to the Best Ever Conference that happens every year. It used to be heavily focused on multifamily, and one of the main people that puts it on, I believe Lisa knows very well. So maybe she can speak a little bit about him.
Joe? Yeah, so Joe Fairless, I mean, he's definitely one of the top players in the commercial real estate. He's done, over $1 billion worth of real estate, I think multiple billion. He has Ashcroft Capital, and he has created the best ever entity. So there's the best ever podcast. He wrote a book. Actually, I think it's one of the ones I have right above my head. Best ever apartment syndication book. And yeah, this was their 10th year doing the best ever conference. And it's always been one of just the top commercial real estate conferences. It's definitely a higher level. It's not a beginner commercial 101 type conference. When you go there, there's pretty much, I don't know if I've ever met anyone there that hadn't done anything. So they've curated a very good conference that has a lot of the top players in commercial real estate. So
thanks for that background. Yeah, I've just realized that we've gone for the past few years, but never really kind of talked about what exactly it is. And they actually have a lot of not only active operators and fund managers and other people doing commercial real estate there, but they also have passive investors that go looking to make connections, looking for opportunities. And we've met a lot of our investors there as well. So with that, just a quick preface for our debrief. This is for educational purposes only. It's not investment advice. And it's coming from our perspectives to help you guys in your investing journey. And so if you have any questions throughout this webinar, please put them in the chat so we can answer them. And with that, I wanted to jump into why conferences are important to go to. Maybe Emma, you can answer.
Yeah. So I think the first conference I ever went to was in like 2019, and it was about raising capital from investor capital. And I remember sitting there and meeting a lot of people in person, but even the ones from because a bunch of us from Salt Lake all drove out to Denver for this conference. And that experience of just being at the hotel, carpooling, even with our own Salt Lake crowd for 3 days, changed the relationship even with those who were local. And I remember being kind of impressed with the quality of the relationships that developed over the overnight kind of experience, and the late night lobbies types of things. And so I felt like, okay, this is definitely worth it to go here. I did attend a conference in 2020, where I was sitting, and it was not necessarily a real estate conference, but I was just sitting there listening to the speaker, and the speaker's wife was sitting next to me, and she was kind of heckling him a little bit. And so she and I started chatting, and she asked, what do I do? I said, I invest in apartments. And she said, oh, my grandma just died, and we inherited her apartment building, but we don't know what we're doing with it. And she told me where it was, and I happen to have an apartment building like 5 minutes down the road from it. And I said, just tell me what you need help with. And so we ended up partnering up on that deal, which we still own today. And several of the partners in that partnership had just been outstanding to work with. Like I would do another deal with in a second. And so that all just came out because and that was in Miami. So that was a big commitment for us to fly out there and stay. And it was a nice hotel. So it was like, we're like, oh, I don't know if I should be spending this much money on this conference, right? But what has come out of that conference is 10x more. And then I kept going back to it thinking like, maybe I'll find a deal again. We've been back to it several times in various places, and we've never found another deal there. But every single time I go, I am strengthening those relationships. And I feel like now, because there's this particular one that I go to frequently, I can call them and say, hey, what's going on? Like, I've got this thing going on. What do you have going on? Been a while. It's been 6 months since we saw you at the conference. And have a reason to call them without sounding like you only call them when you need something. You're just checking in and going out to lunch and finding out what they're volunteering for, what they're raising money for, business deals are doing, family stuff, like just helping each other out with resources. And so the conference there has given me a professional network that you really cannot get with Zoom or I think local meetups are probably the closest thing that you can get to it. But it's like you all come out together for this particular purpose once a year or every other year. It changes the relationship. So that's a benefit, the direct financial benefit we've gotten out of it. But there have been many, many indirect or second order effects of the network with people just introducing me to the right person that I needed to help me with a problem that I was having, whether it was personal or business, just some incredible kind of stuff. So yes, it can be a little bit expensive. And you're like, if you're going to measure each one on the ROI, sometimes you're not seeing the ROI for each particular event, but cumulatively, they definitely add up.
Yeah, that was something, one of the first conferences, I can't remember, it was probably the second or third conference I went to. And I just remember the first couple I went to and people, saying, oh, I just met so-and-so, we're going to partner on stuff. And I'm just thinking, man, like, you just met them, like, in your part, like, you're already finding partners. But in a way, I was thinking, like, well, why haven't I found somebody immediately that is like, I'm going to partner with? And then, you hear down the road of how it was not a good partnership. So they rushed into it. But speaking to one of the gentlemen that was there, he was saying, and he'd been in real estate forever. And he said, if I go to 4 or 5 conferences a year for 5 years, he said, you're spending 150,000 in that 5 years going to those 25 conferences. He goes, I don't go to every conference expecting to meet a partner, expecting to meet someone that's going to like revolutionize my business or do this big change. He says, you have to look at it as the bigger picture. Like, you're always going to find something useful in every conference and some little tidbit of information or meet someone, but not every conference is going to be this like amazing ground shattering conference. He goes, if I meet one person who helps change my business or helps my trajectory in that 5 years, he goes, to me, that's a success. He says, because you can't expect every conference to go there and be meeting these amazing people and partners and stuff like that. And I thought that for me, being new into real estate, new into going to conferences, that was a very good thing to hear, because sometimes you get frustrated to hear all these people and this amazing stuff that's happening. And then you hear the not good things that resulted from it. But yeah, definitely the relationships and the in-person relationships. I think that's a big thing too, because you can meet someone, but actually spending time in person with people, to me, really, you get to know them better, and you just get to build stronger relationships. So, I'm at the point where at the beginning it was, okay, what education is at these conferences that I really want to learn from? And there's always education, like there's always stuff to learn. But now when I look at conferences, I look at it more as, who am I looking to connect with, and are they going to be at that conference? So not necessarily the education. The education is good, but more, who am I looking to connect with, and making sure that I'm going to the conferences. Because there's conferences that, they may not really be what you're looking for, but you might know people that are going to be there, or the type of people that are going to be there. And those are the ones that you're going for, is to that networking and to build those relationships with people.
The people in the room. We invited some locals that had never been to this event. And when he got there, he says, thank you so much, because this is what I needed. He doesn't do anything in that space specifically, but when you keep going to certain events and you're trying to scale, you're feeling stagnant and things like that. And you need to kind of be in a room where you're getting more knowledge from other people. And that's what he was feeling like. And being in that room, he was like, this is amazing. This is a great space for me. This is what I needed to kind of start to, scale and look at the next steps. And then the people in the room are just great. Like you have to reconnect with people that you haven't seen in a while. And that's always fun. You grow those relationships. And then on top of that, you meet so many new people. And then just being able to sit down and chat with them here and there, and every year you get to see, you know, the faces, and they're like, oh my gosh, and you get to catch up. It's a great thing. But to see the new faces and to have somebody like him that comes and he's like, this is exactly what I needed. I was feeling stagnant, and I think this is the direction I needed to start going into.
And I guess, Chris, to going back to what Emma was talking about, how it's different than meetups, because you guys host, you know, meetups all the time with the Utah RIA. I guess, what is the difference between, and I mean, we know because we go to them all the time, between just a regular meetup versus a conference like this?
Well, a conference like this is definitely elevated as far as the well, let me take a step back. I guess it depends on, like, we say conference, there's tons of conferences for all different types of things. It depends on, in context of what conference you're going to. If we're talking specifically about this conference in comparison to like the meetups that we host locally, I would say the biggest opportunity and difference is more of what Harmony was mentioning earlier, is you get to a point in your whatever your journey is that you somewhat hit a ceiling, and the only way to break through that ceiling is to elevate yourself and put yourself in a room where people are doing more than you're doing, right? And then you get ideas and you get motivation by looking at that, and then coming up and then surrounding yourself like with people that are where you want to be. I think that's super important as well. Not necessarily the reason why we go to the meeting, but I think just for in context of the comparison, it's more of like what Harmony said, just trying to navigate and take yourself to the next level. And then once you hit that level, you want to find another room where people are even more elevated than that. And you, if that's your goal, if your goal is to continue to keep scaling up and continue to grow, that's exactly what you need to do, and how you navigate the world of just always educating yourself, always pushing yourself to new boundaries. And I think that was a lot of the sentiment that we've seen at the conference.
And I think no matter what conference you go to, there's always going to be people in the room that are really at a higher level than a lot of people in there. Like, they've already done a lot and they're just there because they go, or they like the people or whatever. And I've seen this at many conferences, not just real estate. But you're never going to have the time, and you may not always get to have the conversations to find those people. So you want to definitely get out to conferences and not be afraid to be uncomfortable. Like, people are afraid to be uncomfortable and go to something like this and say like, well, I don't even do that, or I'm afraid of this, and that I'm not necessarily in that space. Get out of that. Be uncomfortable for a day or two and meet people, because the rest of us are all normal people, and you're going to see that they're just as goofy and have fun with it anyway. So get in those rooms and be uncomfortable and learn something new. That's what I say.
I agree. And I feel the same way, especially when I first started going to conferences and meetups, coming from Hawaii, being in a lot of small rooms and then going to these huge rooms. It was intimidating, but at the same time, it helped me to grow and scale so much faster than I thought I could. So I guess with that, Troy, what was the feeling in the room? Did people feel confident, cautious? I guess,
Yeah.
what was some of
Yeah.
the conversations you had?
A lot of the people that I talked to, they kind of moved a little bit away from multifamily and some of that in general, and moved more in towards like private money lending, hard money lending type of stuff. And I've even talked to quite a few of them that have started kind of refocusing on investing into small businesses, which was kind of surprising that, you know, everybody's kind of experiencing the pinch right now on multifamily and on real estate in general. But they are still investing in real estate. It's just more of office buildings, small businesses, hospitals, that kind of thing. And so that's mostly where I've seen people moving into. They do still invest in real estate, but they're a lot pickier now about the deals they're getting into. They're going to dig a lot deeper into those to try and understand where the best deals are, and they're going to take a lot of time and effort before they actually start placing money in those areas.
And then, Emma, did you feel the same, or did you feel like
Yeah, we went the first time we went, people were talking about it, but it's like every year they keep talking about we're going to correction and it'll come back. We're making it's like the stay alive till survive till 25, and then there's one of 6, and now this year I heard people saying like 27 will be heaven. It's like everybody's just waiting for this correction to be over. I think last year, maybe 2 years ago, was the first time that I saw 2 years ago. It was the first time I saw like this cynicism and the level of, oh, what are we going to do? Right. This year, even though I feel like there's still that kind of feeling is the whiplash is over, and that shock and surprise of like, oh man, we have to pivot. People have pivoted now. And so there's less of the cynicism, and I'm seeing a little bit more of the optimism starting to come back. And it might not necessarily be in what they were doing before. And I personally feel lucky because we had pivoted to hard money lending away from multifamily. Not that we got out of multifamily, right? We just got more picky about what we were buying. But it just happened for us because we were seeing that this is kind of at the height, right? And that means that the bubble's going to burst or there's correction coming. We didn't know how bad it was going to be. We didn't know what was coming. Things were still good, but you just know when things are starting to peak. And we, at that same time, because we were feeling successful with our portfolio, like, hey, I think we could probably like quit the job, like, but we didn't have any cash flow. And so I was like, hey, we really need to start focusing on investments that have better cash flow. So lending became, I remember going to Chris and being like, hey, can I just like put some of my money and have you lend it out? And you're like, oh, I'm not legally set up to take investor capital. And I was like, that's a thing. We should make that a thing, right? Because I felt like I needed to be in that space. And so now so many people are in the lending space, and I feel like I got a little bit of a jump on it because we got it before the correction. So we recognized that we needed to make that shift personally. And now I feel like the first year people were like, you're doing what? You're doing lending, hard money? I thought you were the multifamily type of, like, yes, we're still doing that, but you have to be diversified and you have to be able to make sure that your portfolio is meeting your current goals. Like our life goals had changed, and so our portfolio had to change with it. And plus we're kind of seeing that writing on the wall. And so that type of feeling where people have made the pivots now, and they're starting to say like, well, have you heard about office buildings? Have you heard about hospitals? Like, are you, do you have you're lending? I'm like, I'm hooked up on the lending side. And so those types of conversations are feeling a lot more optimistic than say 2 years ago when people were still just reeling from what are we going to pivot to next. I don't think that there's been like a clear winner that's emerged, right? Do you remember like before multifamily hit its heyday, it was self-storage everything, and it's a self-storage unicorn, and self-storage seemed like it had peaked. And then multifamily kind of peaked. And then self-storage came back because of 2020. And so I think that it was very clear who those kind of top players were in the space. And I don't think that's quite emerged yet. That was the feeling that I was getting from the people that I was talking to. We're still kind of waiting to see what the next unicorn is going to be. But I am seeing overall, because people are kind of grasping at what that might be, just a much more diversified approach where lots of people are into a lot of different things instead of like everybody's multifamily like it was.
And I think that's where we've seen a lot more people when we talk to them that we see them being more successful is where they're more diversified. Because I think with any level of investing in anything in general, you see the ebbs and flows of it, right? We see it in our everyday with the RIAs and things like that. Like the market was really easy and too easy at one point for some people. And then you see it within the commercial space, people over leveraged themselves too. And they weren't very conservative with their underwriting. And it was just kind of like, just dive into it because it was so easy to do. And now you're seeing it to where they were so over leveraged that they were struggling. There's a lot of people losing out on things, but it was those who aren't struggling as much. They're not doing great, but you know what? They're okay because they didn't have all their eggs in one basket. They diversified. And those are the ones that you hear of like, yeah, they've been doing it a while. They can tell that to people, but it's just like when you see it on social media and they think that's the way to go and they run with it, right? They dive all in with one education and that's what they think they need to do. It's instead of trying to, hone in on one thing, get it get comfortable with it and start to expand. Like you hit your ceiling there, start to expand out your knowledge and always try to be diversified and not have everything in in one place. And that was something that I did pull out of the meeting, the conference this year, was those who were being diversified were definitely a lot more comfortable.
Yeah, and less
Yeah,
beginners
this-
in 2017, more experience.
yeah.
Troy.
Some of the bigger players, they haven't really bought much in the last couple of years because they haven't been able to find anything. And as they're starting to underwrite stuff now, quite a few of the operators I was talking to were talking about their underwriting and how they're being super conservative. That they're looking at it as, okay, once we're stabilized, here's our rents. Like they're not building in any rent increases. They said it's just with the way the market is, like we are not going to buy something unless we want to stabilize at those market rates at that time. But we're not looking at it, okay, in 2 years, if we can keep getting 3, 5, 7% rent increases, then it'll be a good deal. They're like, that's, it's just too risky. And so just the underwriting is definitely a lot more conservative now, expecting a little higher vacancy, being much more conservative on rent, doing no rent growth for the next few years. One operator said he has a deal that when he purchased it, he had no rent growth for 10 years. So, and then also just making sure that just being realistic on the underwriting. So yeah, there was one other factor that I was going to say, but yeah, the rent growth, making sure that, your vacancy, making sure you have higher vacancy and also higher turnover cost. Just expecting it to take longer to fill those units from that when somebody moves out. And especially now in certain markets, there's just so much on the market that tenants are moving a lot more. Here in Salt Lake, we're definitely seeing it with ours. Tenants are not staying as long as they used to because now, hey, that new place down the road is doing 2 months free rent and just dropped their luxury A class down to almost the same price as B class type stuff. So yeah, just knowing the market and being super conservative in your underwriting still.
And then what did anybody talk about, or did you hear how people were potentially doing their refinances differently or taking on debt differently?
Yeah, I mean, a couple of people I talked to are, if they're getting to the end of their variable stuff, they're really looking for interest only. A couple of operators, they say we're not, normally at this point we'd be looking for, an advertised loan, but they said right now, just to help with the cash flow until things start to get better, we're just doing interest only to just get as much cash flow as we can from our properties. If we have to refinance, a lot of them are looking for interest only just to keep that cash flow as high as they can.
Yeah, this is something that's sorry, this has been concerning me for several years, is what I'm calling the zombie loans, the ones that refinanced right before the rates went up, because commercial mortgages are only 3, 5, maybe 7 years, there with few exceptions to that. And so every 3 to 5 years, you're having to come into a refinance. And that's where we are right now. Things that refinance late 21, early 22. And we had a building like that we just sold in January because the loan was coming up. And it's like, we either got to sell it or it's not going to perform with these new refinance numbers. And so those zombie loans still need to fully shake out of the system. Performing properties that are not in distress, but will be in distress after a refinance. So that's been a big concern. And I'm seeing more of those are shaking out, and people are feeling better about having exits that weren't complete losses, because they were able to find a decent buyer, and it didn't perform as well as they wanted, but they were able to avoid that zombie loan. So those haven't worked their way completely through the system. Anyway, sorry. Go ahead, Chris.
We'll also see. So we had some presentations at the conference about the overall economy, bank debt. Banks, and especially larger lending institutions are trying to clear out bad debt from their books and over asset allocation to various assets. Multifamily definitely being one of the asset classes that they're looking to trim down their overall portfolio or their exposure to that particular asset. And that was one of the things that we've heard. I've heard from a few people that we were talking to. So even though you have their loans coming due, it's even harder right now to get a refinance because less people are refinancing. And then again, it's all supply and demand. You have banks pulling back and trimming down their portfolio on certain asset classes. So the banks that are still out there willing to lend are going to lend at a higher rate just simply because there's less people lending on it. So it's just, again, the overall macroeconomics still plays a role even on the lending side of things, which was really interesting. And then specific to, again, there's a lot of great assets out there. Troy brought up businesses. There are actually, I want to say, 2 or 3 sponsors that were just doing syndication for businesses, which is pretty interesting. I don't recall seeing that years prior, but even we still see some people navigating different things. That was one of the things that there was a panel of just multifamily operators, and they were still talking about pivoting. Value add was a huge thing 2-3 years ago. That's no longer a thing. Like, you can't, if they're as Lisa was bringing up earlier, rent growths have stagnated, dropped in a lot of cities. You cannot value add something if there's no potential to grow your rent. And you're also running into issues like, again, like Lisa brought up, where you have brand new, like there's a lot of overdevelopment, especially in more urban areas, where the overdevelopment caused impacts to brand new class A's having to give out like ridiculous cuts and concessions that then just trickles down. So you're potentially holding a class C value add, and you're kind of stuck down crap creek without a paddle because class A is just going to just cut it down. And if I'm looking from a tenant standpoint, I want to move somewhere, I'm not going to move into a class C even though it's renovated, because a class A is just going to be brand new. They're going to have different curb appeal, probably different amenities, and they're giving concessions. So it just kind of trickles down. Class A is having a hard time lease up. You've heard of brand new developments struggling at a 50% lease up. We just had a speaker come into our event yesterday, exact same issue. He's not even 50% occupied. He's struggling. I asked him, what can I do for you? He said, bring in half of my tenants. And he wanted a higher rent price than the market demands as well. So there's a definite sentiment in general. And I think kind of, if I had to kind of sum a lot of it up, and Harmony said it is, I think diversification, those that were diversified. And that was, I think, for me, an interesting part of the conference is just you've seen more diversification and different opportunities, which is good. Like, and you want to try to understand the different opportunities and ebbs and flows. And I think Emma brought it up, that they're not, every single asset class is not the same. They operate differently. Like she talked about the heyday between storage units and multifamily, and they all have their own cycles, and they're slightly different. Some of them tie into each other, some of them don't. And it was really interesting to see some market data with urban versus suburb, or secondary versus tertiary markets, and how those assets were performing. Like most of the tertiary, or maybe even there really isn't a definition outside of tertiary, but more of the suburb markets were significantly outperforming the urban markets, and a lot of them were still seeing rent growth, whereas the urban markets, which had massive overdevelopment, are not seeing it. So there's always opportunity. There's always opportunity. It's a matter of sort of like sticking through it and really putting your head down when you need to put your head down. And one of the things that I heard from the panel is just like, you have to work harder, like literally. I think I can't remember who it was, but there was a panel of, and these were multifamily investors, that one of them said that they didn't have any type of loss, so no capital call and no loss, which is almost phenomenal in this market. And the question came up, how did you do it? And his answer was, there's no magic bullet, we just had to work harder, like sleepless nights, and do what we had to do to make sure everything stays in check and
Well, that goes
get,
back to times aren't easy, right?
yeah.
The easy times that now it's you weeded out all of those people who are there for the ride. The magic carpet ride is over, and now you got to be in there to be in it. Like you got to understand it, and you got to be willing to put in the work, and that's where it's at. And so the people who are there are really putting in the work. The rooms have gotten smaller. We've noticed that drastically smaller from 4 years ago, but I wouldn't underestimate those rooms still, because the value in those rooms is still, there's so much value in those rooms. And even though the rooms are smaller, you get to really nurture those relationships more, because now it's not so loud. You get to really get more one-on-one time, which was for me, like, I love conferences. I've always loved conferences in any field I was in, because I'm a people person and I love being able to connect with people. And when you get out of your everyday element and you go into something like this, people are more relaxed. You get to see a different side of them than if you were in your regular office or something like that. So I would never take away or underestimate a room just because of hearing or the market isn't doing that great or anything. Those are the people you want to be in the room with, because when the times are hard and they're the ones showing up, those are the people that, you know what, I want a potential collaboration with somebody like that. Those are the relationships I want to nurture.
Yeah.
Well,
And
and
there
that's you're
thing
also
that
going to find the pulse of what's going on. Like if you keep going to these conferences, interacting with the people that are in those industries, you're going to have a better idea what's coming up and what you should be investing in the future and where people are moving, as opposed to just like watching LinkedIn or that kind of thing. You don't get the same behind the scenes look at what people are investing with without talking to them face to face.
Yeah, another thing that a couple operators were saying was, you know, and I've seen this in Salt Lake Market. You know, a few years ago, you could completely remodel a unit and do all new everything, and you would get the ROI on it. You would get that additional rent, but you're not getting that now. They said, you know, they've been looking at their ROI of making, you know, completely renovating these units when there's a flip. And they said now it's not worth it. People aren't willing to pay extra. You know, obviously if you're going from a completely rundown place to brand new, that's different. But if you have like a place that's solid but just dated, most people are not looking to pay a significant increase just for brand new countertops or brand new cabinets. Like if everything is functional and it still looks good, and yeah, it might be older, you're just not getting the ROI on that. So that was another thing that some of the operators, even like mid-project, had started shifting to. Okay, we're renovating all these units. We're expecting to get a rent premium, but we're just not getting it. So as units are turning, they're doing a much more slimmed down renovation. If anything, you know, maybe some paint or something, but they're not going in and doing this full renovation like they were, because they're just not seeing the ROI on it. So
yeah, and being a parent of young adult children who are out there shopping for apartments, shopping for rentals, trying to see, like, can I ever buy a house? There is a big part of me that like reaches, like my heart reaches out to our tenants, because it's a double-edged sword, because no rent increases is good. It helps wages stretch farther. I mean, it makes it harder on the owners and the operators, but it makes it easier on the renters. Yet at the same time, what you just described there is highly concerning, because when times are tight, that's when things start not getting done as well, because this is where properties become run down. This is where properties become what we used to call a cash cow, where you just take the money out and never put the improvements back into it. And so I think that this leads to another cycle where properties just get to the point where they're just not in good condition anymore. And then they need a huge influx of capital when times are good. And so there are trade-offs and pros and cons to all of it. Whether you're an owner, investor, or if you're like us and kids who are like, hey, I can't find an affordable place to live. And you're like, well, maybe now you maybe can, right? So it's just been an interesting perspective around all sides of this.
And I think it's just interesting to note just all these differences, the risk exposure that people are taking or not taking, the non-negotiables, or just the different look that how people are running their numbers. Because with any real estate deal, it comes down to the numbers. And even when you're investing as an investor, putting your money into something that makes sense is the key to then growing it. So I think we talked about what's kind of working and what you guys have felt and what input you guys got from the conference that other people are doing. So with that, what do you feel like most of the experienced investors there, operators, were investing in, this year and then into the future?
Operators were doing multifamily. They're still doing multifamily. That's not stopping. Again, it's more of they're still pivoting. Like they're still pivoting within the realm of what they know and what they specialize in to some degree. Because they're, like I said, instead of, it's more of like what Lisa said. Instead of what they did in the past, you reanalyze again. At the end of the day, it's realistically all numbers. You reanalyze what's working, what's not working, and then you apply the things that are working. Hopefully, going back to what Emma was saying, if they're a good sponsor, they're not going to let that happen, and those are the ones that you want to find. What Emma's point is spot on, because that will happen especially with underexperienced or people that don't have enough capital reserves, and there's a lot of things that need to be restructured. I think if you're just looking to invest, though, that was a different, I think that was a different sentiment. So if you're on the opposite side of, I'm a sponsor and I do X, Y, or Z, I shift the mindset to I'm an investor, like that. There's way more opportunities again, especially specifically to this conference. 2 years ago, it was almost all services related to multifamily and multifamily. This year, there were still a bunch of services, but there was a large mix of different sponsors that were doing different things. So we had sponsors doing medical buildings. We had sponsors doing businesses. We had sponsors doing strip malls. There's a bunch of different diversified options at the conference. So it's, again, depending on what lens you're looking at. It was, if I'm a LP and I'm trying to do investments, the underlying message was diversification. Make sure you're diversifying your portfolio on risk as well. So Emma talked about more. You have cash flow, you have mitigated risk on one side, especially when you're investing in debt, and then you're taking on different levels of risk as well between different asset classes. So you should be appropriating whatever investments you're doing according to that. But on the GP side, there was some that added, I think Troy mentioned it, that added debt to their portfolio offering. But if they were doing multifamily, they're still doing multifamily. If they're doing triple net, they're still doing triple net. If they're doing storage, they're still doing storage. I didn't see like an overwhelming, and maybe Lisa can speak to this more. I didn't see an overwhelming, we did multifamily, now we're just going to do triple net. They were still doing it, they just pivoted slightly.
Yeah, agreed. There wasn't really anyone I can think of that had like a really hard turn like that I'm completely leaving what I was doing. It's more, we might be doing a little less in multifamily and seeing if there's another asset class that we can diversify into, but they were still staying with kind of their core and what they know, just adjusting how they're underwriting deals, how they're looking at deals, and just being more conservative on those deals. But yeah, there were more people this year just in general in different asset classes, which is always interesting to see, and always good learning on different avenues, because as you know, every niche has a different cycle, and when multifamily is doing good, industrial may not be doing good. When industrial is doing great, retail may not be doing great. So they all kind of have their cycle. So just keeping that diversified portfolio can really help as an investor through things. So
I don't know, Emma or Troy, did you guys see anything different?
No, I mean, like I said, is that people are still investing in those. They're just a lot more conservative in what they're doing. And like I said, they are looking at other opportunities. A lot of them are looking at opportunities they haven't ever been exposed to before. And so they're taking this opportunity to learn about these different investment types and kind of expanding their horizon. It's fun to see the different opportunities they're finding. I've talked to people that are going into oil and gas, and people that are going into mining, and and just all this stuff that you normally wouldn't think of when the real estate market is doing great. But when things start struggling, you start looking for other opportunities. And as you do move into these different types of investments, it's always good to kind of look at the history of those investments and see when it was booming and what happened when it failed, and look at the other markets to see what was offset at that time. So, for example, real estate is kind of taking a dive, but a lot of opportunities are opening up in these other industrial industries and business entities. So, do keep your eye, keep your thumb on those and watch out for it. Make sure you're getting well educated before you do any sort of investment.
Yeah.
Yeah, I talked to somebody mining germanium, so I had no idea what the heck that even is. If you guys know what that is, please educate me. Anybody out there too? Germanium. He
It's
says
what
it's a gold mine.
Captain America's shield is made out of.
I think that's vibranium.
No, it's the thing that they mine on Pandora with the blue guys, and then they make shields out of it.
No, that's unobtainium. Sorry, I am a professional at that, so you'll want to.
I'm definitely investing new when it comes to precious metals. I think talking to the service providers, because Lisa mentioned that like people aren't buying as many things, but yet the people who are really good at multifamily, for example, they're still buying. And what you're seeing there is less people are in the market. And so transactions are way down because the newbies are like, this is too hard, or I had to go back and get a job, or whatever it was. The people who were really at the top of the game, they are buying less, but they're still buying. But overall, with all the newbies out, the transactions are down. So the syndication attorneys are probably the best metric on this when they're saying, oh, I was doing this many hundreds of transactions 3 years ago, and this year I did 2 or something like that. I talked to a lender who said he has not underwritten a loan in over a year. And it's like, you have to be, that's a perfect example of diversification, because he also did insurance. And so his ability to kind of bounce back and forth between loan origination and insurance is how he kind of keeps things afloat during the downtimes. And so these downtimes, I think, are a good opportunity for us to look at where our weaknesses are, where our portfolio's vulnerabilities are. And it's not necessarily a bad thing to evaluate how little you are diversified. If you're 90% exposed in real estate, then I'm sorry. I don't care how good you are at it or how good real estate is. It to me, it's like, concentrate on what you're doing actively, but diversify passively. And one of the speakers that was there he helps people set up like small family offices. And he was saying that when he first had his first IPO, he had all of a sudden went from a net worth of just a regular working class W-2 guy for a startup to a net worth of like $3 million overnight. It was like winning a lottery. And he's like, I had no idea what to do with this. And he goes, not only did I not know what to do with $3 million, but when I looked at my allocation, it was like 90+% in this one company because it went public. And he immediately had to step back and say like, okay, I got to take some money off the table. Here's a big windfall for me, but how am I going to reallocate this? And winning the lottery is one of the most stressful things that can happen to somebody in their lifetime, because people don't know what to do with their money. They don't know how to manage their money. And the opposite is also true. If you're over concentrating in something and that thing is not performing well, then you got to go get a job, or you got to do something else to try and keep the lights on. And so that diversification to me is a huge source of comfort. And watching the difference between 2018, when everybody's doing multifamily, to now people who are good at multifamily are still doing it, but just taking that look and saying like, where am I overexposed? What's the difference between growth investing, cash flow investing, and wealth preservation? Those 3 things are maybe not being equally represented or to meet your goals. So these downturns are just a great opportunity to take a look and see if you're one of the people who've been swimming naked when the tide was in, and then the tide goes out and you're like, oh, whoops, how to do this right. So it's an opportunity for us to get new swimwear.
Very much like that.
I
They
can't
can
remember
reference.
who it was. I can't remember who it was that was talking about just kind of several people were saying they think we finally hit kind of the bottom and we're skidding along the bottom of the multifamily market. And it might have been Joe during one of his talks when he was just talking about. So they interviewed a handful of GPs and just some of the numbers that they had gotten. So they interviewed 45 GPs. 90% said they plan on doing more deals in 2026 because they feel that they're kind of at the bottom and now will be a good time to buy. 16% working with the fund of funds has been very effective because it has been harder to raise capital. 32% are prioritizing expanding new capital and working with fund of funds just to get more access. And overall, they were saying, yes, 2025 was difficult. They do expect 2026 to be better. And one of the biggest things that they're working on is improving their SOPs for capital raising and trying to expand their network and where they're capital raising. So it was just kind of some interesting information that a lot of them do feel we are hopefully skidding along the bottom, and we'll start to slowly see that uptick in multifamily.
Awesome. Yeah. So what I'm hearing is, in closing, that for suggestions for people that are looking to still invest, operators, or if you're looking to still passively invest, there still is opportunity out there. Just make sure whatever you're investing in or whoever you're investing in is underwriting conservatively as possible. Every investment is a risk, so nothing is guaranteed, but you just want to make sure that they are accounting for things like Lisa had brought up in the underwriting process, as far as, the rental increases, not increasing by too much, or maybe staying steady across the next couple of years, accounting for maybe higher vacancies, turnovers, and like Emma had pointed out, just how they're going, if they are looking for short-term investments or 3 to 5 years, what are they going to plan to do in that time if they're going to refinance, or how they're taking on debt, so that when that time comes what the plan is. Because a lot of people don't think about it until 3 to 5 years later, and like Emma said, a lot of people are up against the gun now or suffering because they didn't foresee this environment, which I don't think anybody could have foreseen how quickly things turned. But that's, the beauty of just thinking outside the box, investing, and keeping your money growing and making these investments that are a little bit more creative. So I think, to tackle what Troy said too, just looking into other things as well that you never thought of, like oil and gas, plutonium, or whatever other businesses are out there, or that you can start on your own too. Maybe just honing it back into it, even buying a rental property. You can do so much more than you realize. And I think the goal is not to be scared. Of course, be optimistic, but also be conservative. And then go to conferences like Best Ever and get surrounded by people that are not scared of continuing on, weathering the storm, and that are maybe seeing success in other areas that you could tap into as well. So with that, mahalo. Thank you guys for joining us today. We are Retoro Capital. Please reach out to us at retorocapitalinvestments.com. Message us on any of the social platforms that, if anybody tuning in right now on Facebook, LinkedIn, YouTube, leave us a comment, like, and subscribe to our channel as well. And we will catch you guys on the next one. We hope.
Bye, everyone.